Before I start, I just want to say thank you for 50,000 subscribers. I really hope my videos can continue to make that subscription worth it. But before this turns into an Oscars speech, in 2017 there was not a single private individual anywhere in the world with a net worth exceeding $100 billion. However, in late November of that year, thanks to a rally in Amazon's stock price, Jeff Bezos entered the 12-figure club, although technically he wasn't the founding member. 18 years earlier, at the height of the dot-com bubble, Bill Gates briefly had a net worth of over $100 billion before the crash. This time though, these fortunes have stuck. Since crossing this line, Bezos has never left the 12-figure club. Even after his 2019 divorce, where 25% of his Amazon stock was transferred to his now ex-wife Mackenzie Scott, Bloomberg estimates that he just held on. It took more than 18 months for Bezos to get some company. But in June of 2019, Bernard Arnault, the chairman of the luxury goods company LVMH, briefly reached the milestone before dropping out once again due to sales slowdowns from COVID. But then something changed. March 15, 2020 was the day that changed the global economy for the wealthiest people on the planet in profound ways that we are only now fully realizing. From then, the number of private citizens worth more than $100 billion has gone from 1 to 17. And not only are there more of them, they are getting richer. In March of 2020, Elon Musk barely registered on the Bloomberg list with a rather modest net worth of only $30 billion. In less than 5 years, his net worth has grown more than 14 times over as he recently became the richest man in modern history, surpassing even the inflation-adjusted estimates of John D. Rockefeller. But Musk isn't the only one. Almost every single ultra-high net worth individual has seen their fortune grow over the past 5 years. You have to search all the way down to number 46 on the list, to poor old Jack Ma, who stands out as one of the only billionaires in the world who's less wealthy today than they were 5 years ago. Now, the rich getting richer is nothing new in our global economy, but it's become so concentrated in just the past 5 years that now the merely ultra-wealthy are being outcompeted by the hyper-wealthy. If the cost of living is hitting you hard, spare a thought for the average billionaire, as they've been dealing with the most severe inflation they have ever experienced.
Oh, boo-hoo! Let me play a sad song for you on the world's smallest violin.
This is serious.
I know. This really is the world's smallest violin. See?
Dassault, Bombardier, and Gulfstream are the 3 leading companies in the market for high-end private aircraft. In just the last 3 years, they've each come out with the Falcon 10X, the Global 8000, and the G700 respectively, representing the largest and most expensive aircraft they've ever offered to the market. The companies don't officially list pricing guidelines because, well, if you have to ask. But industry brokers and outlets generally agree that they start at $80 million for the basic airframe. Fittings and fixtures can add an additional $10 to $20 million from there. Someone with a mere $1 billion simply couldn't reasonably afford to purchase one of these aircraft. Even assuming they could liquidate 10% of their net worth, that would be a highly irresponsible purchase because these planes also depreciate and cost several $1 million a year to maintain and operate. Despite being out of reach for even run-of-the-mill billionaires, these new planes are so popular that there's a waitlist of up to 2 years for deliveries. According to public flight records, Jeff Bezos frequently flies around with 2 previous-generation Gulfstream G650ERs that shuttle himself, his family, and his staff all over the world. The practical justification for this is that these 2 aircraft offer redundancy in case one goes down for maintenance, and also offer more capacity for his extended entourage without using a commercial jetliner that can't land in certain remote airports. According to admittedly unsubstantiated rumors, Bezos is also one of the few lucky individuals that's already taken delivery of the brand new G700. It's not just planes, there's now so much purchasing power among the 200 wealthiest people on the planet that a new market has developed for homes, cars, politicians, and experiences that only they can afford. And the price of these goods and services has outpaced regular CPI inflation by a massive degree. When the Bugatti Veyron launched in 2005, it was the most expensive production car in the world, with an inflation-adjusted price of around $1.5 million. Fast forward 2 decades, and the latest offering from Bugatti is now more than 3 times as expensive, even after accounting for inflation, and it's not even that special anymore. The fastest growing automotive market segment in the world over the last 10 years has actually not been electric vehicles. According to Statista Market Insights, that market has grown by 2,000% when including plug-in hybrid vehicles, which is very impressive, but not as impressive as the growth in car sales worth more than $1 million. Now, the data on these vehicle sales is a lot harder to reliably collate, and there were obviously far fewer sales to begin with, but the outcome is still very clear. There are now more than 100 different cars from dozens of different brands worth well into the seven figures that are catering to an emerging market of ultra-wealthy people that simply didn't exist 20 years ago. Now, a $3 million Ferrari or a $5 million Bugatti is far more budget-friendly than a $100 million jet. But even this price inflation isn't the whole story. Money alone isn't enough to buy these cars. The ultra-wealthy clientele of these brands are encouraged to spend tens of millions of dollars on other cars in the brand's lineup before they'll even be offered the opportunity to buy a seven-figure sports car. After that, if they're lucky enough, they might even be offered a one-off which can run into the tens of millions. The rich have gotten richer at a rate roughly 3 times higher than regular inflation. One of the fastest growing consumer markets in the world are the 500 individuals on this list. Companies have merely reacted by adjusting their prices to what the market will bear. It's the same for yacht builders that are booked out until 2030, tickets to exclusive high-profile events, and even homes in suburbs popular with the global elite. High-end inflation means that regular billionaires just can't play the same game anymore. Now, I know all of you watching are deeply saddened by the single-figure billionaires struggling to get by in a world that's pricing them out. But even for you heartless few that don't actually care about them, the bigger problem here is what this quiet shift represents. It makes sense that as money lost its value, the people with the most money would feel it the most. But that's still not the whole story. March 15th was the same day that interest rates in America were dropped to an all-time low of 0.25%. And fiscal stimulus efforts around the world really went into effect. The first round of COVID stimulus checks were distributed and the market started to turn around as more people had more money to invest and spend with large businesses. In aggregate, the average person was spending a lot less at their local restaurant or going on holidays and was spending a lot more on dubious investments, shopping online, or buying a new car at rock-bottom interest rates. This was a massive injection of cash into the economy that started with the people that really needed it, but flowed primarily to people who were already wealthy asset owners. Other schemes like the now infamous Paycheck Protection loans focused on those struggling small businesses did the same thing. They might have helped the little guy a bit, but they helped the big guy a lot. This wasn't just happening in America. Governments in most major economies were very generous with stimulus efforts, which largely had the same effect everywhere. People were also desperate to invest into anything because they were seeing headline after headline about how their money was buying less every month. Buying up assets was the only way to maintain purchasing power, even if those assets were overvalued. The top 1%, and more specifically, the top 200 individuals, overwhelmingly have their wealth invested in these businesses. So as a wave of new people entered the market for the first time, they ended up pushing up the value of these ultra-wealthy individuals. But that was then, and this is now. Interest rates around the world have not only been raised back up again, they are now higher than they were before the pandemic, all in an effort to curb the inflation caused by the extra money pumped into the system in the first place. The savings of the average people have evaporated and consumer debt has taken its place. Layoffs have hit the professionals that were making good money in fields like technology and finance particularly hard, and the cost of living has hit everybody else. This would normally have slowed things down as there are fewer people investing, but that hasn't really happened. The companies behind the individuals on this list are all worth more today than they were even at the height of cheap money and cash giveaways. And why? Well, a few reasons. The most obvious explanation would be natural business growth. If these companies were making more revenue or growing their profits, then their heightened valuations would make sense. But that hasn't really been happening. The Shiller price-to-earnings ratio is a closely watched financial metric that tracks how much companies have earned over the past 10 years and compares it to how much those companies are worth based on their current stock price. So if companies are earning a lot of money and their shares were very cheap, the Shiller PE ratio would be very low. But it isn't low. It's actually higher than it was in 1929 or 2008 and even 2020. It's the highest it's ever been, with the exception of 1999 at the height of the dot-com bubble. The higher interest rates and lower cash availability that would normally slow markets down also make it much harder for new businesses to emerge that could challenge the dominance of today's incumbents, which is making them a more attractive long-term investment even if they take generations to realistically pay off. Another way to think about this is that the price of these stocks have increased without the fundamentals to back it up. Money's buying less, which is just inflation. The only difference is it's not inflation in consumer goods and services, it's inflation in asset prices, which is where the super rich do most of their actual spending. 90% of these shares are owned by the top 7% of households, and you may not be surprised to learn that the group growing their share of equity the fastest is the 0.1%. As the rich have become richer, they're no longer just outbidding each other for jets, cars, and yacht parking for the Monaco Grand Prix, they're outbidding each other for the assets that made them rich to begin with. The potential of AI has been used to justify these valuations because of the business potential this technology could unlock, but what that potential actually is has always been a bit of a sensitive subject. OpenAI, the technology leader in generative AI, recently launched a $200 per month subscription to use their most sophisticated tools on demand. It's a hefty price tag that most consumers wouldn't even consider, but even then, the company's still losing money on these services because their systems cost so much to run, both from the energy requirements and the amortized cost of chips to run it all. Even still, there's a reason that the world's biggest companies can't afford not to invest in this technology. It's not because it will ever be a revenue generator, it will be a cost cutter, and as the market has become more uncertain about the real value of this technology, they are getting less shy about admitting that.
We at Meta, as well as the other companies that are basically working on this, are going to have an AI that can effectively be a sort of mid-level engineer that you have at your company that can write code.
The IT department of every company is going to be the HR department of AI agents in the future. Today, they manage and maintain a bunch of software from the IT industry. In the future, they'll maintain, nurture, onboard, and improve a whole bunch of digital agents and provision them to the companies to use.
Now, as always, please tell me why I'm wrong in the comments section. Healthy discussions make everybody better informed, and of course, nobody truly knows where AI is headed. But what is clear is the astronomical price the hyper-wealthy are paying for the most coveted good of all, something that's become far more expensive to purchase: influence. Government spending as a portion of total economic activity is higher today than it's ever been, with the exception of the Second World War. Having the charisma and connections to get a say in where that money's directed and what gets regulated is just part of being an effective business leader these days. It shouldn't be this way, but it's simply the reality we live in. Regular lobbying just doesn't cut it anymore, and now business leaders have to pay the highest price of all: their dignity. We've all watched as the individuals at the top of this list have lined up to kiss the ring ahead of the inauguration, because the only realistic way they can continue to inflate these fortunes is to avoid regulation and get government support in the new economy. Had the results of this election been different, these same business leaders would be talking about their green initiatives, diverse boards, and rigorous fact-checking. The wealth dynamics at the very top of the pile have become so strange that in our modern world, the ideas outlined by the grandfather of capitalism seem almost socialist. Go and watch our video on that to see what Adam Smith really said about free markets, massive wealth accumulation, and the role of government. And subscribe for more micro issues with big impact.